Hello everyone, a very good morning. I hope you all are doing well. Okay, so today we'll be practicing questions from Module D. Yesterday we had done Module D in our revision. Good morning, good morning. So Module D is extremely important, factual, many things to remember, and questions are asked from Module D, direct questions. Okay, so we'll be practicing the direct questions, factual questions today. Are we ready? Everyone is here? So let us start with the first question for today. Okay. Which of the following statements accurately reflect the nature of the bond market? It is a highly volatile and it is suitable for aggressive investors. It facilitates short-term capital access for the startups. It is a platform for trading debt securities with lower volatility. It exclusively deals with equity instruments. Good morning, Prabhakar. Good morning. Everyone, answer this question. So, we are starting with the unit 23, the different types of investment products, under which first we have a bond. What are bond? What is a bond? Bond is a fixed instrument, right? Fixed income instrument. The issuer of the bond is somewhat a borrower. The companies, government, private companies, large companies, all of them, they issue bonds. They are known as a borrower. And the investors, they are known as creditors. So a loan is forwarded by an investor to the borrower. And yes, when we are talking about the bond market, no, Krishna, bond market is for trading the debt securities with lower volatility. Highly volatile, suitable for aggressive investors. It is the equity market. Okay. Bond market is stable. The returns are stable. They do not vary much. And they are issued by the issuers for raising capital in the long term nature, not in the short term. All right, in the long term capital. So the correct answer should be C. It is a platform for trading debt securities with lower volatility. All right. Consider the following statements about tactical management in wealth management. So, what is wealth management? We have already seen. It is a combination of the financial services to address the needs of the affluent clients. It includes tax planning, estate planning, retirement planning, portfolio, financial services management, right? Which is provided to the business owners, corporates, or an individual for a higher fee. Now, it is of three types. We have asset allocation management, tactical management, and diversified management. Diversified management. So, which of the following are correct about the second one? It involves selecting appropriate tactics to achieve the financial strategies. It is primarily focused on income generation through fixed deposits. Why am I getting C as the answer? It emphasizes choosing the best alternatives for financial execution. It is a passive investment approach with minimal client interaction. You need to select the correct statements. Correct statements. Yes, the correct statements are B, 1 and 3. It is not focused on just fixed deposit. See, what is asset allocation? Asset allocation's primary goal is to focus on initiating income, to start income generation for the client, initiate it. And it is not that also is not focused on just one type of instrument, a balanced mix among the investment categories. Tactical, appropriate ways to achieve the financial strategies, appropriate tactics, choosing the best alternatives. Diversification means flexible model, right? The investment management is flexible, that would help meet the client's needs. Okay, do not be quick to answer. Read the statements carefully and then answer, please. Otherwise, you will lose easy marks in your exam. Questions are not tough. All you need to do is read carefully. You have studied everything. Alright, so the correct answer is B, 1 and 3. 2 and 4 are incorrect. Okay. Consider the following statements about the regular convertible bonds. So we have studied about the convertible bonds. There's the option of converting the bond into equity shares of the issuer, either on maturity or at predetermined intervals at predetermined prices and rates. There are three types of convertible bonds. There's the regular convertible, mandatory convertible, and reverse convertible. So, which of the following statements are correct about regular convertible? They have a fixed maturity date and predetermined conversion price. They obligate the investor to convert into equity at maturity. They are commonly issued to the public. They offer higher interest rates than the mandatory convertible bonds. Which of the following statements are correct? Which of the following statements will be correct about the... No, not correct. You need to answer the incorrect statements. Which statements are incorrect? Incorrect statements. The question says you need to answer the incorrect statements. Sorry, I did not tell it before. Change your answer. What are the incorrect statement? Yes, correct, Krishna. Great. The incorrect statements are 2 and 4 only. They have a fixed maturity date and predetermined price. In the regular convertible bond, the investor has the right or the option to convert into the equity shares of the company. There's no obligation, it is not compulsory for them. So they are issued to the public. Generally, they are issued to the public. In mandatory convertible bond, the investor is it is compulsory for them to get their bonds converted into equity shares of the company. And how there's a compulsion here, it is they're essentially forced to convert their bonds. Thus it will be a higher price, a higher rate of interest. Reverse convertible bond, the investor does not have the right or the option, the issuing company, the issuer has the right to convert them into equity shares upon maturity at the predetermined conversion price. Okay, so the correct answer is C. Everyone has answered C. Yes. Evaluate the following statements about government bonds. They are considered extremely safe due to the sovereign backing. They are issued for tenures from 5 to 40 years. They are available only to the institutional investors. They form a significant portion of the Indian bond market. Which of the following statements are correct about government bonds? Government bonds. They're issued by central and state government to tide over liquidity crisis for development of infrastructure. They're usually long-term bonds, right? The different types of government bonds that we have studied about: fixed rate, floating rate, sovereign gold bond, inflation indexed bond, zero coupon bond. So the correct answer, yes, the correct answer is A, 1, 2, and 4 only. They are available not only to the institutional investors, they are also issued to the commercial banks, individual investors, cooperative banks. Okay, so large as well as small investors can subscribe in the government bonds. So 1, 2, and 4 are correct. Regarding the reverse convertible bonds, consider the following statements. The issuer holds the right to convert the bond into equity. The investor is obligated to convert the bond at maturity. The conversion price is predetermined. These bonds are typically issued by the government entities. Which statements are correct about the reverse convertible bonds? Reverse convertible. What will be the correct answer about reverse convertible bonds? We have already discussed, right? So the first statement is correct. Issuer holds the right to convert and the conversion price is predetermined. Okay, the investor is obligated to convert is a feature of the mandatory convertible bond, and these bonds are not typically issued by the government entities. These are issued by all other types of entities as well, by the large companies, issuing companies. Okay, yes, the correct answer is D, 1 and 3. Which of the following statements best explain the risk associated with the long-term fixed rate bonds? They are subject to frequent interest rate resets. They offer no interest payment during tenure. They're vulnerable to inflation-induced value or erosion. They're auctioned at variable spreads. So the fixed rate bonds which are issued by the government, which of the following statements best explain the risk associated with it? The risk that is associated with it. Everyone who's present here, also please like the video. Like the video, everyone. Yes, the correct answer is C. Simple question. C. They're vulnerable to the inflation-induced value erosion. So when the fixed rate bond is of a longer term and inflation increases, this benefit will not be given to the bond. Okay, so even in a situation of a boom in the market, when the business cycle is in the boom, then also we won't have the benefit. Also, the inflation goes on increasing. So if the value is fixed, the comparing it to the inflation, the value of money will be low. Okay, so the correct answer is C. In the floating rate bonds, which component remains constant throughout the bond's tenor? The benchmark rate, spread determined via auction, reset frequency, or the total interest rate. So what happens in the fixed rate bond? They are applicable for the government bonds. It is fixed for the entire tenor, regardless of the fluctuating market rates. The lock-in period is 1 to 5 years. Premature withdrawal can also lead to penalties. In the floating rate bonds, however, there are variable interest rate, which are based on the periodic changes experienced by the rate of returns. And the intervals within which these changes occur are made clear prior to the bonds being issued. Right? So we split the rate of interest. The rate of interest is split into two. There is the base rate and then there is the spread, right? The base rate and the fixed spread. Okay, so when we are investing in the floating rate bond, we will consider what is the benchmark rate, the spread, the amount of shift in the rate over and above the benchmark, what is the recent frequency. No, the thing that remains the same or stable, the name itself tells us it is the spread which is determined via the auction. All right. There's the base rate which changes and the fixed spread. The spread is determined via auction and it remains stable right up to the maturity. So who answered B? Spread determined via auction is correct. All right. So when are we going to buy such floating rate bond? When the rates are low and they're expected to rise in the near future. All right. The change is dependent on the benchmark rate. So the benchmark rate is obviously going to change. The spread remains stable. Which of the following features is unique to the sovereign gold bonds? Physical delivery of gold at maturity, taxable interest income, redemption allowed anytime post issuance, nominal value based on the average gold price prior to issue. The sovereign gold bonds. Here I can invest in the digitized form of gold for an extended period of time without having to avail gold in its physical form. The interest rate, how is it tax free or is it taxed? How the nominal value is derived? Are there any limits imposed on what amount of sovereign gold bond an individual may hold? What is the liquidity and redemption? So which of the following is a unique feature? Unique feature, we are not asking the correct statement. The feature which is unique only to the sovereign gold bond. B, no, the interest is not taxed, it is tax free. The interest which is generated in sovereign gold bonds is tax free. B is incorrect. Tax free. Yes, the nominal value is based on the average gold price. So 99 purity, 99% purity, 3 days prior to the issuance of the bond in question. The Indian bullion, they determine what is the price of the sovereign gold bond. All right, so the correct answer is D. Regarding the retail bonds, consider the following statements. They are issued by the companies to raise capital. They're typically unlisted and illiquid. They are they offer fixed interest rate for a defined tenor. They can be traced during the regular market rates. Which of the following statements are correct about the retail bonds? The fourth category of bonds. Retail bonds. Is it to raise capital? Does the company issuing the retail bond, are they issuing it for raising capital? Yes, true. They are the retail bonds. If the company wants to raise additional capital, they have already issued bonds. Now for running their project, they need some additional extra fund. So they raise these additional capital by borrowing at a fixed rate from an investor for a specific length of time, right? To expand their business, to pay off their debt, or to fund a specific project. However, the retail bonds are typically listed on the stock exchange. They can be bought and sold during the regular market hours. They are not unlisted, they are not illiquid. The correct answer should be A, 1, 3, and 4. Okay, to raise additional capital, they are offered for fixed tenor and fixed interest rate. They can be traded during the regular market hours, so they are listed and they are liquid. They can be bought and sold on the exchange. Clear, everyone? The correct answer is A. Evaluate the following statements about the inflation index bond. They are typically issued for the retail investors. The returns are linked to the CPI or WPI. They offer fixed nominal interest regardless of inflation. They help preserve the purchasing power during the inflationary periods. Answer this question, very simple. Which statements are correct? 2 and 3, 1, 2 and 4, 1 and 3, or all of the above? Read the statements carefully and then answer. Yes, what will be the correct answer, everyone? The name itself tells us they are inflation index bond. So the returns will be linked to the consumer price index or the whole price index, right? Then they help preserve the purchasing power during the inflationary period. This is also true. It will be indexed to inflation. So if the inflation is rising, accordingly the interest rate will also change. And they're typically issued for retail investors, but they do not offer fixed nominal interest rate regardless of inflation. Why? The name itself tells us it is inflation index. It is linked to the inflation, the current inflation in the economy. So if inflation increases or decreases, the bond coupon will also increase or decrease. The benchmark for determining the rate of interest is inflation, CPI or WPI. Alright, so B should be correct. Why am I not getting answers? What happened? Tired already or what? Consider the following statements about the 7.75% Government of India savings bond. They replaced the 8% saving bond in 2018. The interest earned is exempt from income tax. They are issued in the multiples of rupees 1000. NRIs and minors are eligible to invest. Yes, what is the correct answer about this Government of India savings bond? 1 and 3, 2 and 4, 1, 2 and 3, or 1, 3 and 4? C, 1, 2 and 3. Is the interest earned exempt from income tax? When we were talking about the sovereign gold bond, there the interest was tax free. But when we are talking about the Government of India savings bond, the interest earned is taxable according to the investor's tax slab. Yes, the correct answer should be A, 1 and 3 only. NRIs and minors are not eligible, and they have replaced the 8% savings bond in 2018, and they can be issued in the multiples of rupees 1000. Okay, so who all are not eligible? NRIs, minors, HUFs are not eligible. Okay, so the correct answer is A. Hmm. Which of the following best characterizes the risk return symmetry in the sectoral mutual fund? So, what is a mutual fund? Wherein the pool is created by various investors. Then the asset manager, they will invest the money into the various bonds, stocks, or whatever is the scheme, and then the investors, they get the units. So what is the risk returns asymmetry in sectoral mutual fund? Sectoral funds offer guaranteed returns if the sector outperforms the benchmark index. They exhibit low correlation with macroeconomic cycles due to sector insulation. They concentrate exposure, amplifying both upside potential and downside risk. The sectoral funds are mandated to diversify across unrelated sectors. So, what is the correct answer about the sectoral mutual fund? So, there are different types of mutual funds: equity mutual fund, investing in the stock market; debt, in the debt instruments like treasury bills, government bonds; balanced partially into equity, partially into debt. Sectoral funds, yes, we invest as per the selected sector, like IT or banks or the FMCG, pharma, and the manager will control the stock selection based on the selected sector preferences. The returns are based on the stock performance belonging to the specific sector only. So the correct answer is C. They concentrate the exposure. There is both the potential of higher returns or higher risk. Okay, so the correct answer will be C. Consider the following statements about the debt mutual fund. They're ideal for investors seeking capital preservation with predictable returns. They are immune to interest rate fluctuation due to the fixed coupon structures. They may include instruments like treasury bills, government securities, and corporate bonds. They are subject to credit risk and duration risk depending upon the portfolio composition. Which statements are correct? Debt mutual fund. Yes, here also C is true, 1, 3, and 4. They are not immune to the interest rate fluctuations. They are stable as compared to the equity mutual fund, stock mutual fund. They are stable relatively, but they're not completely immune. They're not completely risk free. Rest everything is correct. The instruments are T-bills, G-SECs, and corporate bonds. Okay. Regarding the retail mutual fund investors, consider the following. They may access the mutual funds via direct plans or distributor-led regular plans. They're eligible for the tax benefits only under the debt schemes with lock-in. Their investment decisions are often influenced by the past net asset performance and fund ratings. They're restricted from investing in the closed-ended funds due to liquidity constraints. So, retail mutual fund investors means individuals. Individuals. So which of the following statements will be correct? Which of the following statements will be correct about the retail mutual fund investors? So they have the option. They can access the mutual funds directly or through the distributor-led regular plans, which will be managed by the fund manager, the asset manager. They are not eligible for the tax benefits only under the debt schemes with lock-in. No, they can also invest in the other areas without the lock-in period, which is also there. Then their investment decisions are often influenced by the past net asset value, and they can also invest in the closed-ended fund. So the correct answer should be A, 1 and 3. They are not restricted from investing in the closed-ended fund. Okay, there is no restriction there. So 1 and 3 is correct. Only 1 and 3. Consider the following statements about the SIP. SIP facilitates rupee cost averaging and disciplined investing. It mandates a fixed investment tenor and cannot be modified mid-cycle. They are made in pre-selected mutual fund schemes at defined intervals. The returns are guaranteed if invested in the debt-oriented schemes. Which statements are correct about the SIP? So SIP and SWP. Systematic investment plan, systematic withdrawal plan, which we have also studied under the mutual fund. So what is correct about the SIP? Rupee cost averaging, disciplined investing, yes. So the it is a disciplined way of investing offered by the mutual fund. If I am the investor, I can invest fixed amounts at regular frequency, every month, every quarter, whatever. So I can invest fixed sum of money at in the selected scheme of mutual fund at predetermined intervals like monthly, quarterly, etc. Okay, so one is true. It does not come with a fixed investment tenure, pre-selected mutual fund schemes, and the returns are not guaranteed. Returns are not guaranteed anywhere. Okay, if the question gives you that the returns are guaranteed or this much return is fixed, it is wrong. Investment means risk. The investment that I'm making today is clear. I know how much I'm sacrificing my present income, but the returns that I'm going to get in the future are unpredictable. Unpredictable. Okay, so the correct answer is A, 1 and 3. Theoretical class videos. We are having the theoretical revision on the Oliveboard platform. Tomorrow at 6 p.m. in the Maha Marathon, we'll be revising the theory again. We'll be doing it quickly because we need to cover all the 5 modules tomorrow and day after tomorrow. But we have 4 to 5 hours on a daily basis tomorrow and on Saturday as well. So we'll be doing the theory there. Okay, otherwise you can join the rapid revision batch where we are revising the modules. We have already revised almost all the modules. Okay, okay. In the context of systematic withdrawal plans, which statement best reflects its operational mechanism? SWP withdrawal allows withdrawal of capital gains only, not principal. SWP mandates the fixed withdrawal frequency across all the schemes. SWP involves the redemption of the units of NAV and transfer of proceeds. It is restricted to equity mutual fund with the lock-in period. So what is correct about the systematic withdrawal plan? Which statement is correct about the systematic withdrawal plan? B. Fixed withdrawal frequency across all schemes. Is there a fixed withdrawal frequency across all schemes? Crash course capsule batch videos accessible for those batch. It should be there. Connect the team once. It should be there. Okay, let me get back to you. Let me get back to you. Let us do these questions and then let me see what can I do. Yes, so there is the SWP allows us to withdraw at fixed interval, true. But I can choose the amount and the frequency of withdrawal. All right, for all the customers, it is not same. For all the clients, it is not fixed. I have the flexibility to choose the amount and the frequency of withdrawal. And then on the set date, the units of my portfolio will be sold and the fund will be transferred to my account. So it is not fixed. It involves redemption of the units of the NAV and transfer of proceeds. All right. So the SWP for all the customers, the statement B says that it has a fixed withdrawal frequency across all schemes. No, it will be different for different schemes. It can be different for different customers. I can choose when I want to withdraw and how much I want to withdraw. Okay, and the third statement is correct. Regarding the real estate investment trusts, consider the following. It allows the small investors to access real estate income streams. It generates income primarily through the capital gains on property resale. They are required to distribute a majority of their income as dividends. The REITs are structured as pooled investment vehicles regulated by SEBI. Which statements are correct about the real estate investment trust? The real estate investment trust. Yes, what should be the correct answer? The first statement is correct, right? Investing in real estate is very expensive. I need crores to invest in land or house today. But the small investors, they can park their money. So real estate investment trust is sort of a mutual fund. Here also, a pool is created. These asset owners, the real estate owners, what they will do, they will give the asset on lease, on rent. Whatever rent is generated from that, the investors are paid. Not on the sale value, not on the property resale. Okay, so the first statement is correct. Small investors to access the real estate income streams. But primarily through capital gains on property resale, no. What they do? They give the property on lease, they give the property on rent. And from the rent or the leasing agreement, whatever is there, the payment is made of the dividends to the investors. Third statement is also correct. Required to distribute a majority of their income as dividend. They are a structured pool investment vehicle regulated by SEBI. So 1, 3, and 4 should be correct. Yes, Chaitanya, great. 1, 3, and 4. Okay, the second statement is incorrect. Property resale is not done. They manage the estate portfolios, mortgages, including leasing activities. They generate the rental income, and the income so earned is then distributed among the investors as dividend. All right. The organization that owns and operates the real estate, they generate a regular flow of income. Which of the following best illustrates the inverse relationship between risk and safety in investment decision? What is investment? Revenue minus expenditure. Whatever is left is saving. That saving we are going to invest to generate returns in the future. So what is the relationship between risk and safety? Equity shares, they offer high safety due to market transparency. Government bonds offer high returns due to elevated risk. Real estate investments are highly liquid and low risk. Bank deposits offer low returns but high principal protection. So there are certain components of investment. There are certain components of investment. We have return, which is the primary objective of any type of investment, right? Expected return can be a regular income like interest, dividend, or rent, or it can be an increase in the value of investment like capital appreciation, difference between the selling price and buying side, right? Risk means variability in return. because of loss of capital or non-payment of income. Safety means that the investors will get their original principal on maturity. There should be no loss in the value, there should be no hindrance in the original principal. Yes, the correct answer is D. Okay. Bank deposits, although they offer low returns, but the high principal protection is there. The principal of the investor is not lost in any manner. Regarding real versus financial assets, consider the following. Real assets are more liquid than financial assets. Real assets include tangible items like land, gold, and silver. Financial assets are intangible instruments representing contractual claims. Financial assets are more suitable for portfolio diversification and regulatory reporting. This is also easy, easy question. Which statements are correct about the difference between real and financial assets? Between real and financial assets. Is it 2 and 3, 1 and 3, 2, 3 and 4, or 1, 2, 3 and 4? D. Real assets are more liquid than financial asset. What is the meaning of liquidity? Liquidity means how easily can an investor sell their investment in the market without incurring much cost or with less energy and less time. Real assets are land, gold, and silver. Is it easy? Can I sell? Can I decide that I'm going to sell my land today and tomorrow I'll be able to do it? Will I get my payment? And is it cost free? No. Real assets are not more liquid. Financial assets are more liquid. The correct answer is C. Okay? Real assets are tangible. It is difficult to sell them. That is the meaning of liquidity. Financial assets, the various types of equity, stock, share that I can buy and sell in the market. They are more suitable for portfolio diversification. All right, so C should be the correct answer. Yes, C. In investment theory, liquidity is best defined as, I already told you what is liquidity. The ability to earn regular income from an asset, the assurance of principal recovery at maturity, the capacity to hedge against inflation through asset appreciation, the ease of converting an asset into cash with minimum cost and delay. What is the best definition of liquidity? Yes, it is D. Ability to earn regular income from an asset is the returns factor. Principal recovery is the safety factor. Capacity to hedge against inflation could be risk, right? Hedging. And ease of converting is known as liquidity. How liquid it is. Okay. In the context of leveraged finance, investment banks primarily provide equity capital to the startups, lend funds to firms for asset acquisition using the high debt ratios, facilitate sovereign bond issuance for fiscal deficit management, offer insurance products to hedge against credit default. So we have studied about the difference between investment management and investment banking, right? So under leveraged finance, what do the investment banks primarily do? What do the investment banks primarily do? They they lend the funds to firms for asset acquisition using high debt ratio. Leverage means debt. Using leverage means using debt. Okay, so what is the difference between investment management and investment banking? Investment management means dealing with the clients who have surplus money, they want to get returns, they want to invest in the various asset allocation, financial system, statement analysis, stock selection. Investment banking, on the other hand, is to help those clients who are in a situation of deficit. They want to raise capital or mergers or acquisition. So, issuing securities on their behalf, managing the connecting the company with the investors, that is done by the investment banking. What distinguishes proprietary trading from other investment banking services. It involves trading on behalf of the institutional clients. It is regulated by SEBI under the Banking Regulation Act. It involves trading securities using the bank's own capital for profit. It is exclusive for the government owned investment banks. So, which statements are correct? How is proprietary trading different from other investment banking services? How is it different? How is it different? Proprietary trading would mean buying and selling securities, right? Simple. What do the investment banks do? They involve trading security using the bank's own capital for profit. The bank's own capital, it is used to create the various stocks, equity, whatever they want to issue. Right? So, C. Same question. In a firm commitment underwriting, the investment bank. So, there are three types of underwriting services: firm commitment, best efforts, all or none. So, what happens in the firm commitment? The investment bank acts as a broker and earns commission per share sold, guarantees full subscription by purchasing the entire issue, returns the unsold shares to the issuer without liability, cancels the deal if full subscription is not achieved. What should be the correct answer? Yes, it is B, right? Returns the unsold share without liability is best effort. Canceling the deal is all or none. So if 100 shares are issued, right, the entire 100 shares will be purchased by the underwriter, the investment bank. This is firm commitment. Out of 190 are sold, 10 will be returned back to the issuer without any liability. It is best effort. Out of 190 are sold, 10 are remaining. The complete 100 will be returned back to the issuer. All or none. The deal will be called off. Okay. Evaluate the following statements about the full service investment banks. They provide advisory services for mergers, acquisitions, corporate restructuring. They manage the institutional and individual portfolios under the asset management mandates. They conduct equity research to support trading and investor decision making. They are prohibited from trading in proprietary trading under the SEBI norms. So there are two types of investment banking. One is the investment banking division of the bank, right? And second is the investment bank, which is a full service investment bank. So, which of the following statements are correct about the full service investment bank? Yes, the correct answer is A, 1, 2, and 3. They are not prohibited from engaging in proprietary trading, right? So the full service investment bank, they offer a wide range of services: underwriting, mergers and acquisitions, sales and trading, equity research, asset management, commercial banking, retail banking. Investment bank, however, investment banking typically covers two key areas: the mergers and acquisition advisory and underwriting only. The full service offers all of these services. Okay. Regarding the sales and trading operations, consider the following. They facilitate secondary market transactions for institutional and retail clients. They may execute trades using the firm's own capital to generate profit. They are restricted to the equity instruments and cannot trade fixed income securities. They support liquidity and price discovery in financial market. Which statement is incorrect? You need to pick out the incorrect statement about sales and trading operations. About sales and trading operations. Yes, what should be the correct answer? Which statement is incorrect? They may exercise trade using the firm's own capital. No, this is the main purpose of sales and trading. The main purpose of sales and trading operation is using the firm's own capital to conduct the trades. We had seen this in a previous question also, right? uh, Distinguishing the proprietary trading from other investment banking services. It involves trading securities using the bank's own capital for profit. Yes, the incorrect statement is that it is restricted to equity instrument, cannot trade fixed income securities. No, they can sell both, they can trade both equity instrument as well as the fixed income securities. Okay, so you need to mark the incorrect statement. The incorrect statement is C. Regarding the investment bank office structures, consider the following. So, the organizational structure of the investment bank comprises the front office, middle office, and back office. So, consider the statements. Middle office is responsible for direct client acquisition and deal origination. Front office generates revenue through trading, advisory, and research. Middle office ensures financial control and strategic risk oversight. Back office handles the operations, settlements, and IT infrastructure. So, what is the role of the three offices? Front office, the revenue is generated. Three primary divisions are there in the front office: investment banking, sales and trading, and research. Right? Middle office has the control function to make sure that the investment bank doesn't engage in the activities that could be detrimental to the bank's health. So, risk management, financial control, corporate treasury, corporate strategy, and compliance. And back office provides the supporting activities like operations and technology. Yes, all your answers are correct. 2, 3, and 4. Okay. In the context of investment banking, what does the term market maker imply? A firm that guarantees IPO subscription, a firm that provides liquidity by quoting buy and sell prices, a firm that manages pension funds and retirement assets, a firm that regulates trading activity. So I told you in yesterday's revision session as well, this market maker concept is very important. Investment bankers, investment banking is known as market maker. Why? Why is investment banking known as market maker? Why is it known as market maker? What is the meaning of making market? It guarantees IPO subs. There's no guarantee. There's no guarantee ever in investment. Why? Why would it guarantee IPO subscription? I told you, whenever there's something, a fixed promise that your IPO will be subscribed or there will be a guaranteed return, it is incorrect. Market maker means yes, a firm that provides liquidity by quoting buy and sell prices. Banhar, yes, okay. It provides liquidity. The investment bankers, they act as intermediaries between the issuers, the issuer company, and the investors. The issuer company who wants to raise capital will approach the investor. This is known as the buy side. And then the investment bank will approach the investors on the sell side. So they're buying and selling the shares, the equity, whatever is raised by the issuing company. So buy and sell, creating liquidity in the market. That is why they are known as market makers. They make the market for the investment. Okay, so the correct answer is B. Which portfolio management strategy is most suitable for a client seeking index linked returns with minimal cost and volatility? So, there are four types of portfolio management strategies. In which portfolio management there is index linked returns and minimal cost. Index linked returns and minimal cost. Yes, what should be the correct answer? It is the Yes, it is the passive portfolio management. What happens in the active portfolio management? We are trying to beat the index, take different position. So there is more churning, buying and selling. Discretionary means full powers to decide are given to the portfolio manager. They will decide what to buy, what to sell. Passive means mimic the index. Non-discretionary means the portfolio manager will only give advice. The final decision to buy or sell is with whom? It is with the client, it is with the investor. Okay, so C. Consider the following statements about mutual fund versus portfolio management. What is the difference between mutual fund and portfolio management services? PMS allows direct engagement with the portfolio manager, and the mutual fund engagement is limited to the periodic disclosures. Mutual fund investors retain ownership of the underlying securities and they have voting rights. The PMS offers higher customization aligned to the investor goals and risk profile. The mutual fund fee structures include profit sharing above the hurdle rate. What should be the correct answer, everyone? What should be the correct answer? It is A. Correct. So what is the difference between mutual fund and portfolio management? Which has more customization? Obviously, portfolio management. The strategy is tailored specifically to the goals of the investor. Mutual fund customization is to the extent of the classification and diversity of the fund, whether it is a debt mutual fund or it is a equity mutual fund. So the scheme engagement, obviously the portfolio manager is more engaged with the client as compared to the mutual fund manager. Fee structures, the mutual fund charges a fixed free fee, the entry and exit of investment and annual expenses. Portfolio manager, they also demand a share in the profit. Asset ownership, the investor retains the direct ownership in portfolio management, but in mutual fund, the investors, they only get the units. Okay, there's also important point. Minimum 50 lakh rupees should be there with you. Only then you can avail the portfolio management service. But in the mutual fund, there's no restriction. Any amount you can start investing in the mutual fund. Okay, so the correct answer should be A, 1 and 3. 1 and 3 only. All right. Regarding the non-discretionary portfolio management, consider the following. The portfolio manager executes the trades independently based on the market conditions. The investor retains the final decision-making authority over trades. PMS acts in an advisory capacity without execution rights. It is suitable for investors with high market knowledge and time availability. Non-discretionary. Discretion means independence to decide. Freedom. Non-discretionary means complete freedom is not there. So here the portfolio manager will only advise the client. They are in the advisory capacity. They cannot independently execute the trades without the investor's consent. The investor retains the final decision making, right? So what should be the correct answer? Keep answering. Drop down your answers in the comment box in the live chat. Keep answering. The correct answer should be C, 2, 3, and 4. The portfolio manager executes trade independently. This is the discretionary portfolio management services. Discretionary would be for those investors who have less time and less knowledge about the market. Non-discretionary would be for those who have time and they have market knowledge. They just want advice from the manager. Okay, so 2, 3, and 4 are correct, and statement 1 is incorrect. Under SEBI's revised portfolio management services regulations, what is the maximum permissible operational fee? 1% of the average asset under management per annum, 0.5%, 0.75% of the total portfolio value, 50,000 rupees annually as per the PMS account. So SEBI in 2020 has given a new set of regulations. Accordingly, what should be the maximum permissible operational fee? Yes, it is 0.5% of the client's average asset under management. Okay, no upfront fees will be charged. Keep in mind, no upfront fees will be charged, and the operational fees excluding brokerage cannot exceed 0.5% per annum of the client's average asset under management. Okay, so the maximum operational fees excluding brokerage cannot be more than 0.5%. Which of the following is mandatory in the monthly PMS performance report as per the SEBI? Now, the manager will also have to give the monthly report to their client. What information should be there? The gross returns before expenses and taxes, only equity holdings and the net asset value, net returns including cash and the liquid fund position, annualized returns based on the benchmark indices. What should be mandatorily included in this report? A monthly report is mandatory. Yes, the performance reported net of expenses and after tax. The statement 1 says gross returns before expenses and tax. No, it should be net of all the expenses and after the tax has been paid. What is left? Okay. Only equity holdings and NAV? No. It will include the net returns, including the cash and liquid fund position. Yes, the correct answer will be C. Okay. What all will be included in the report? Value of the portfolio, description of the securities and goods, cash balance, aggregate value of the portfolio. All of these things will be included in the performance report. The performance report which is given monthly to the client. Okay, C. What is the minimum net worth requirement for the portfolio managers under the SEBI's revised norms? What is the minimum net worth? 2 crores certified by the registered merchant banker, 10 crores certified by SEBI itself, 1 crore certified by the PMS operator, 5 crores certified by the chartered accountant. Only Prince is answering. Prince? Yes, Kamala. Yes, correct. 5 crores certified by the chartered accountant. Correct. A CA has to certify the minimum specified net worth of the portfolio managers of rupees 5 crores. All right, so before distributing the product, the service, this has to be certified. Which of the following statements best reflect the SEBI's stance on exit load structure? No exit load is permitted under any circumstance. Exit load must be flat across all years of investment. It reduces progressively over 3 years and is nil thereafter. Exit load is applicable only on equity oriented portfolio management services. What is the exit load? What is the meaning of exit load? Yes, the correct answer is C. Let's say I entered into the portfolio management services with a manager in 2020. I want to stop availing the services in 2021. So I will have to pay 3% penalty as the exit load. right? So it is less than 1 year. Then if I exit in 2022, then 2% exit load. In 2023, 1% exit load. After that, if I continue availing the services for 3 years and then exit the scheme, zero will be the exit load. There will be nil exit load. All right, no exit load is applicable after 3 years. All right. Consider the following statements about direct and indirect taxes. Also, there was another point. If the portfolio management, the portfolio managers, they have to onboard the clients directly, avoiding the client engagement with intermediaries and distributors. However, if they are employing distributors, then only certified distributors who have the AMFI registration numbers or they have cleared the NISM services exam, only they should be employed. Okay. Which of the following statements are correct about direct and indirect taxes? Direct taxes are non-transferable, must be paid by the person on whom they are levied. Indirect taxes are levied on the income and profits of individuals and corporations. GST is a comprehensive indirect tax replacing multiple state and central levies. Corporate tax and income tax are examples of indirect taxes. So, what is a direct tax? Where there is no shifting, the incidence and impact of the tax falls on the same person. So, for the salaried individuals, income is taxed, and for the business clients, their profit is taxed. Indirect tax is not on the income or profit, it is on the sale of goods and services. The goods and services which are availed by the consumers and they can be shifted. Okay, the various indirect tax, VAT, ZAT, all of these have been now subsumed under the GST. So the correct answer should be B, 1 and 3. Now, fourth statement is incorrect. Corporate tax and income tax are examples of direct taxes, not indirect taxes. Okay, so the correct answer is B, 1 and 3 only. All right. Evaluate the following statements about financial year and assessment year. FY is also referred to as previous year for income tax purpose. AY is the year in which the income is earned and FY is the year in which it is assessed and taxed. No, AY is the year in which the income earned in the FY is assessed and taxed. Both financial year and assessment year begin on 1st April, end on 31st March of the following year. Income tax returns are filed during the financial year in which the income is earned. So let's say I have filed my taxes in 2025-26, right? So when I was filing my taxes, this I mentioned as the assessment year. When we opened the site, there was the option, right? Filing the ITR for assessment year 2025-26. So the year in which the ITR is filed is AS, the assessment year. Year in which I earn my income 2024-25 from 1st April 2024 to 31st March 2025, the income that I have earned in the financial year. I need to pay taxes on that income in the assessment year, right? And financial year for the income tax purpose is also known as previous year. So the calendar year in which the income is earned is financial or previous year. The calendar year in which the income is taxed is the assessment year following the financial year. So 1, 2 and 3 only are correct. Income tax returns are not filed during the financial year, they are filed in the assessment year. Why? Because the income cannot be taxed until it is paid. So only when I receive my full income during the financial year, only then the government will tax me on the income. All right, so the correct answer is A, 1, 2 and 3. Under the amended Income Tax Act, which of the following conditions would trigger the deemed deemed residency for a citizen of India. So we have studied about the residential status. When would someone be known as a non-resident or a resident, ordinarily resident? In that, there was a small point of deemed resident. So which of the following conditions would imply the deemed residency status? Income from the foreign sources exceeds 15 lakh rupees and tax liability exists abroad. Income from Indian sources exceeds 15 lakh rupees and no tax liability exists abroad. Stay in India for 60 days and the income is below 15 lakh rupees. Citizenship alone is sufficient for deemed residency. Yes, what is the correct answer? What will be the correct answer for the deemed residency of a citizen of India? Deemed residency means no. If there is no tax liability abroad, if there is tax liability, why would they pay tax to India again? If they're earning, yes, if they're earning rupees 50 lakhs or more, and there is no tax liability abroad, only then they will be required to pay taxes to our government. Then they will be known as a deemed resident of India. Deemed resident of India. Okay. Which of the following individuals would be classified as non-resident under the Indian law? A citizen who has stayed 185 days in India and has earned 20 lakh rupees from Indian sources. A foreign national who stayed 60 days in India and 400 days in the preceding 4 years. A person who stayed 150 days in India and has no tax liability abroad. A citizen who stayed 50 days in India and earned 10 lakh rupees from the foreign sources. So, what will be the correct answer here? What will be the correct answer? See, the residential status. How do we determine the residential status of an individual? If their stay in India is for more than 182 days, or in the immediately preceding 4 years, more than 365 days, and in the immediately preceding financial year, more than 60 days. If someone leaves India for more than this time period for taking up a job or run a business for a purpose, and we do not know when they're going to return, then they will lose their residential status. Does anyone want to answer this question about the non-resident? Which of the following would be a non-resident? So, a citizen of India who stayed 50 days only and earned 10 lakhs from foreign sources. So, neither their stay in India is eligible nor they are earning anything. So, they could be a traveler, right? They came in India to travel. They visited Agra, they saw the Taj Mahal. Then they visited Delhi, they saw the Red Fort. They visited maybe in the northeast, they went to the south, saw Rameshwaram, and they went back. Okay, so they are a traveler. They stayed in India for 50 days. They earned 10 lakh rupees from foreign sources only. Nothing they earned in India. So they are a non-resident Indian. Okay, a non-resident. All right, clear? The categorization of resident and non-resident is clear. Under the resident, you also need to check whether they are a ordinary resident or a not ordinary resident. Okay. Hmm. Consider the following statements about the resident classification. Under the Income Tax Act, the resident not ordinarily resident requires residency in at least 5 out of 10 preceding years. An individual staying in India for 182 days or more in the financial year qualifies as a resident. This is the most basic statement. So obviously this is correct. A citizen of India with income exceeding 15 lakh and no liability abroad is a deemed resident. Then a resident ordinary resident status requires both 2 out of 10 years and 730 days conditions to be satisfied. Do you want to answer this question? What should be the correct answer? Second statement is correct. Fourth statement is also correct. Yes. What is the condition for a resident not ordinarily resident? The condition for a resident not ordinarily resident. For a ordinarily resident, we will see whether they have been a resident of India in at least 2 out of 10 years or 730 days in the immediately preceding 7 years. Okay, if this is not there, then what will happen? They will be considered as a resident, non-ordinary resident, right? 5 out of the 10 preceding years. So this is also correct, right? This is correct. Only one statement is fulfilled, second statement is not fulfilled. Third statement says a citizen of India income exceeding 15 lakh with no tax liability abroad is a deemed resident. This should also be correct, right? So I think all the four statements should be true. All the four statements should be true. C, 1, 2, and 4. No, it should be D. All right. A citizen with income exceeding 15 lakh rupees and no tax liability abroad is a deemed resident. It should be D. Under section 194P, which of the following conditions must be satisfied for a senior citizen above 75 years to be exempt from filing an income tax return? Income must include capital gains and pension. Income must be from pension and interest from the same bank. Income must be below 5 lakh rupees and from any source. Income must be from foreign pension and domestic interest. So those citizens under section 194P, they are exempt from filing the ITR. When? When will they get this exemption? Resident senior citizen between the age group of 60 to 80 years. So those senior citizens aged 75 years who have a pension and interest income from the bank as their only source of income, right? So they are given a conditional relief. So the correct answer is B. Income must be from pension and interest income from the same bank. Yes, correct. Okay. So if they have income and pension from the bank, they are given conditional relief. Conditional relief means the banks will continue to deduct tax on the senior citizens as per the rules. Just the conditional relief is given to them. If if they're filing ITR and the pension and interest income is their only annual income source. Evaluate the following statements about surcharge and cess applicability. Health and education cess is levied at 4% of the total tax liability. Surcharge of 15% applies to income exceeding 1 crore but not exceeding 2 crores. Surcharge rates are uniform across all taxpayers under both regimes. Cess is waived for senior citizens under section 194P. We just now discussed about the section 194P. It is about the annual income from interest and pension only. So cess will not be waived. Okay. How do we apply the cess and health and education cess and surcharge? 4% health and education cess is there, true. Okay. And when we talk about the surcharge, earlier there were two slabs for it. 10% for 50 lakh to 1 crore, 15% from income exceeding 1 crore. Now, till here it is same. Till here it is same in the new tax regime as well. Beyond that, if the income is more than 2 crores, then 25% surcharge is there. And if it is more than 5 crores, then how much surcharge is there? 37% surcharge is there. Okay. And it is, no, this is also correct. The surcharge does not vary between the senior citizens or below senior citizens. Okay, so it should be A, 1, 2, and 3. They are uniform across all the taxpayer categories under both regimes. They are uniform. Okay, surcharge and cess will be applied for all of the classes of citizens. There is no different slabs for it. Okay. Consider the following statements about the disallowed deductions under the new tax regime. Now, this is very important. Either I can choose the old regime, pay the higher taxes, but claim deduction, or I can go with the new regime where I can pay the lower taxes because the slabs are more and I'll have to forego the allowed deductions. So, which of the following are not allowed? Professional tax paid by the employee is deductible. Standard deduction on salary income is allowed. Leave travel allowance and house rent allowance are disallowed. Interest on housing loan under section 24 is not permitted. Which of the following statements are correct? B, 2 and 3. Standard deduction on salary income is allowed in the new tax regime. Are you sure? No. In the new tax rate regime, those which are not allowed are leave travel allowance, house rent allowance, conveyance allowance, daily expenses in the course of employment, relocation allowance, helper allowance, children allowance, any special allowance. Standard deduction on salary is also not allowed. Professional tax, interest on housing loan, all of these are not allowed under the new tax regime. So the correct answer should be 3 and 4. Yes, the correct answer should be 3 and 4. Okay, these are allowed in the old regime, but they are not allowed in the new regime. Which of the following instruments under Section 80C offers the shortest lock-in period? There are, however, some deductions that are still allowed in the new tax regime. Some are still allowed, like the transport allowance for the specially abled people, conveyance allowance for expenditure incurred for traveling to work, the notified pension scheme investment is allowed, employment of new employees is allowed. Okay, however, the previous were not. Which of the following instruments offers the shortest lock-in period under Section 80C? PPF, ELSS, tax saving fixed deposit, or the Sukanya Samriddhi Yojana? Yes, ELSS. Correct. Very simple question, right? The various tax saving schemes, the ELSS offers the shortest period. It means they have a lock-in period of 3 years. What else is given to us? The Public Provident Fund, 15 years. It cannot be withdrawn before 15 years without a penalty. Then the equity linked saving schemes we have discussed is 3 years. The tax saving fixed deposit will depend, right? Tenor of 5 years is there. It is 5 years. And Sukanya Samriddhi Yojana will be till the girl child gets to the age of 21. Okay, 21 years. So the correct answer will be B, ELSS. Yes, correct. Which of the following cannot be claimed as a deduction under Section 80C? Life insurance premium paid for spouse, investment in the National Savings Certificate, premium paid for parents' life insurance, contribution to the EPF. Which of the following is not claimed as a deduction under section 80C? Under section 80C. Again, this is simple. Yes, life insurance premium towards spouse, children, self is allowed. However, premium paid for parents, brothers, and sisters are not allowed as a deduction. Okay, so the correct answer will be premium paid for parents' life insurance. Regarding the investment planning under Section 80C, consider the following. PPF has a 15-year lock-in and qualifies for full 1.5 lakh deduction. EPF contributions by employees are eligible under 80C. National Savings Certificate interest is tax-free, fully exempt under Section 80C. ELSS offers market-linked returns with a 3-year lock-in period. Which statements are correct? 2 and 3, 1 and 3, 2, 3 and 4, or 1, 2 and 4. When we are talking about the National Savings Certificate, it is used to earn tax saving up to 1 lakh per year. But it is not tax free. We are only saving on the tax. It is not fully exempt. So the correct answer should be D. Yes, the correct answer is D, 1, 2 and 4. If you're answering it correctly, then it is clear, I hope. We have discussed about all of these EPF, ELSS, PFS. Yes. Which of the following statements is true regarding the section 54F? It applies only to the sale of residential house property. Only capital gains needs to be invested to claim exemption. Entire sale consideration must be reinvested in a new residential house. Exemption is available only if the new property is purchased within 6 months. Section 54F. Exemption on the capital gains on the sale of any asset other than a house property. 54 means I'm selling the house property, I'm using the proceeds to purchase another house property. 54F says capital gains are from the sale of a long term asset other than a house property. The entire sale consideration will be invested to buy a new residential house property. Not just the capital gains, but the entire sale consideration. And the property has not to be purchased within 6 months, either 2 years after the sale of property, 2 years after sale, or 1 year before the sale of the capital asset. We can also invest it in the construction of the property, but the construction should be completed within 3 years from the date of sale. All right. So which statement is true? The entire sale consideration must be reinvested. Okay, must be reinvested. A few more questions are left. Please answer. Don't be passive. Try to answer the questions. Also, everyone who has newly joined the session, please like the video. Okay. Consider the following statements about the short-term capital assets. Listed equity shares held for 12 months or less are short-term asset. Unlisted shares are short-term if held for less than 24 months. Immovable property short term if held for 24 months or less. Zero coupon bonds are short term if held for less than 36 months. So the difference between short term capital gain and the long term capital gain. Various assets are there. Immovable asset like land, building, house property. Movable like vehicles. They're also intangible like patents and trademarks, equity and share, right? For immovable property, less than 24 months is considered to be the short term capital. Certain assets, the period is not 24 months, it is 12 months, like equity or preference shares. listed on the stock exchange, securities on the stock exchange, units of UTI, zero coupon bonds, units of equity oriented mutual fund, whether quoted or not. Right? Yes, the correct answer is A, 1, 2, and 3. Zero coupon bonds are short term if held for less than 12 months. Okay. And any of these held for more than 20 24 months or 12 months will be classified as the long term capital gain. So I'm holding the liquid listed equity shares for less than 12 months and I'm selling it. So I purchased them in March 2025, and if I sell them before March 2026, then it will be a short term capital gain. Okay. For bonus shares, the holding period is counted from the date of purchase of original shares, the date of company incorporation, the date of dividend declaration, or the date of allotment of bonus shares. What should be correct? In case of bonus shares, how do we calculate the 12-month period? From the purchase of original shares, or company incorporation, or the date of dividend declaration, or allocation? Yes, it is. It is the date of allocation. When I get the bonus shares allocated, DDS. Consider the following statements about mutual fund mobilization by banks. So, questions from the last unit. These questions are from the last unit. When mutual fund business is carried out by banks, which of the following statements are correct? Abolition of entry loads, reduced upfront commission from 3.5% to 0.75%. Restrictions on bank investment in debt funds have impacted the institutional mobilization. Retail mobilization remains viable due to the bank's network and the customer base. Trail commissions are no longer permitted under the SEBI regulations. What should be the correct answer? The mutual fund business by banks. What should be the correct answer? Trail means what? Trail says the loyalty commission. Trail is the loyalty commission. So when the banks they offer mutual fund, first statement is true, right? Collection of entry loads for equity based schemes have been abolished. So the commissions which are offered have been reduced from 3 to 4% to now it is 0.75%. The debt side restrictions have been introduced on banks when they are investing in the debt fund, right? Upfront commission 75 to 100 basis point. I know we have not revised it. That is why I'm not getting the correct answers, right? The correct answer is A. Trail commissions have not been abolished by SEBI. They have been reduced. The trail commissions have been reduced, but they're not abolished. Okay, so 1, 2, and 3 is correct. Abolition of the entry loads has been done. Banks now they are restricted to invest in the debt market. Retail mobilization remains viable. But trail commissions are still permitted, just that SEBI has recommended some limits over it. Consider the following statements about endowment policies. Which statement is incorrect? They provide a lump sum payment on the maturity or death. They may include critical illness coverage depending on the issuer. They combine savings and insurance facilities. They are cheaper than the term insurance policy. So, when we are talking about insurance policy, life insurance policy, we have endowment policies, term insurance policies, money back policies, and pension plan. right? Here it is asking about endowment policy. So it is contracted, it is designated to pay a lump sum after a specific term on the maturity or on death, like 10 years, 15 years, 20 years, right? So endowment policy includes a lump sum payment. Lump sum payment is made in the endowment policy. You need to mark the incorrect statement. Incorrect. Incorrect. You are telling me the correct answer. That is the main basis of endowment policy. Term insurance policy is only, the amount is paid only on the death of the policy holder. The amount is paid to the nominees or the beneficiaries. That is the term insurance policy. Yes, the correct answer is D. They are not cheaper than the term insurance policy. Term insurance policies are cheaper. Why? Because if the policy holder survives, they do not die, they do not get anything in the term insurance policy. They only get some tax benefit. However, in the endowment policy, the lump sum is paid after the maturity of the term as well, not only on death. That is why term insurance policy is cheaper. Okay? The policy holder does not get any monetary benefit at the end of the policy term except for the tax benefit. Okay? Only on their death, the nominees they get the amount. Consider the following statements about insurance broking departmentally by the banks. So there are certain options. Banks can conduct the insurance business either departmentally or through setting up of a subsidiary or a joint venture. When they are doing it departmentally, they can do it without risk participation only. They cannot participate, they cannot contribute in the risk. So, departmentally, what should be true? 50 lakh deposit must be held with the same bank offering the broking services. Board approved policy should be there covering distribution model, suitability, grievance redressal. The LDI license and annual fee are mandatory for the broking operations. Staff incentive must comply with the Banking Regulation Act of 1949. When we are talking about insurance business with the risk participation, it can be done only through the subsidiary, right? There, the net worth, minimum capital is required. Departmentally, it is not. The only requirement is that at the time of application, the bank has to pay a non-refundable deposit, right? They need to pay a non refundable deposit and they also need to pay annual fees. All right. This deposit of 50 lakh rupees, this deposit of 50 lakh rupees is to be maintained by an insurance broker with another scheduled commercial bank other than itself. Yes, the correct answer is B. 2, 3, and 4. The 50 lakh deposit will be held by some other scheduled commercial bank. They cannot keep it with themselves. And the deposit will be, there will be a lien on that deposit. ILDI will have a lien over that deposit. Okay, so the correct answer will be B. Rest all the statements are correct. There is the requirement of the 50 lakh deposit, true, but it will not be kept by the bank with itself. They will keep it with another scheduled commercial bank. Keep this thing in mind. Who is going to have lien over it? IRDAI. All right. Rest the things, board approved policy, license from IRDAI. They will ensure customer appropriateness, a performance assessment, and incentive structure will be decided. Any restrictive policy should not be followed. Grievance redressal mechanism should be there. Evaluate the following statements about the subsidiary or the joint venture eligibility for insurance business. Net NPA must not exceed 3% as of 31st March of the previous year. The bank must have made net profit in the preceding 3 financial years. Bank must maintain prescribed capital, including capital conservation buffer, After investment, the bank must have a net worth of rupees 500 crore before investing in the subsidiary. So if the bank wants to take insurance business with risk participation, they can do it only by setting up of a subsidiary or a joint venture, right? So which statements are correct for doing that? A, 1, 2, and 3. Correct. Correct, correct. When they are setting up a subsidiary, the net worth should be 1000 crores. 1000 crores. And once they invest in the subsidiary, then the net worth should not be less than 500 crores. All right. Before investing 1000, after investing 5000. Then minimum prescribed capital after the investment is required. Net NPA should not be more than 3%. Net profit in the preceding 3 financial year. A track record of the performance of its subsidiary should also be satisfactory. Now, if the bank want, they can also set up a subsidiary and act only as a broker. Then their net worth should not be less than 500 crores, right? If they want to set up a subsidiary or a joint venture, but they do not want to participate in the risk, they are only acting as a broker, then they should have the net worth of rupees 500 crores. Minimum prescribed capital, net NPA, profit, rest everything is same. Just the net capital differs. Which of the following best describes the dynamic group cover offered to the loan borrowers? When we are talking about insurance, group insurance is also offered. Which statement is correct about the dynamic group cover? Fixed sum assured for natural and accidental death, cover linked to the outstanding loan amount reducing over time, cover equal to the original loan amount throughout the tenor, cover that includes overdue amounts and penalties. What should be correct? Group insurance products are offered for identified groups that are homogeneous, right? Different group insurance covers to their customers as a value addition is also offered by the bank. Banks, like there are the different savings account holders, current account holders, loan borrowers, term deposit, recurring deposit holder. There is two types. There are two types of group covers. One is a simple fixed cover, right? What happens in a simple fixed cover? On the happening of the natural or accidental death, and the amount of cover is fixed. Let's say 1 lakh rupees for natural death and 2 lakh rupees for accidental death. However, the premium will be charged on the annual basis. Second is the dynamic cover, which is provided to the borrower accounts. It is provided to the borrower accounts on a reducing basis. So the retail loans, housing loans with mortgage backing, premium payment for the cover is a single premium mode, which is covering the repayment period of the loan, and it covers the death of the borrower during the repayment period. All right, it will not take care of the overdue amounts in the loan. All right, only the outstanding loan amount. Overdue loan amount penalties are not covered in this type of dynamic group cover. Okay. Which of the following statements is true regarding the duplicate cover under the Pradhan Mantri Jeevan Jyoti Bima Yojana? Jeevan Jyoti Bima Yojana. Multiple policies are allowed if premiums are paid. Coverage is extended to 4 lakh rupees if two policies exist. Duplicate premiums are forfeited. Coverage is restricted to 2 lakh rupees only. Duplicate policies are merged for enhanced benefits. So these are the two social security insurance scheme. The Pradhan Mantri Jeevan Jyoti Bima Yojana and the Pradhan Mantri Suraksha Bima Yojana. Jeevan Jyoti Bima Yojana is a life insurance cover for death due to any reason, right? Who all are eligible? Participating banks, they hold the bank account of these individuals in the age group of 18 to 50 years. In case of multiple bank account, they can get they can join the scheme through one account only. And in case the member is covered by with more than one account, then the insurance cover will happen what? It will be forfeited. Okay, they will get the benefit from one account only. This will lead to termination. All right, what else can lead to termination of the account? On attaining 55 years of age, closure of the account, or insufficient funds are there in the bank account for auto debit. If the member is covered with LIC or any other insurance company, or they have more than one account through which they have subscribed. Okay, then evaluate the following statements about the premium appropriation under the Jeevan Jyoti Bima Yojana. The premium is 436 per member. 436 per member. How is it distributed? 239 rupees is paid to the insurance company per member. 30 rupees is reimbursed to the business correspondent micro corporate agent per member. 11 rupees is reimbursed to the participating bank per member. 106 rupees is retained by the government for administrative purposes. Which statements are correct? 1, 2, and 3, 2 and 4, 1 and 4, or 1, 2, 3, and 4? All of the above. Which statement is correct? Which statements are correct? The correct answer is not D. The correct answer is A. 1, 2, and 3. 106 rupees. Government is not retaining anything. If anything is remaining, it will be used for the administrative expenses by the participating bank. All right, not by the government. Government is not retaining a part of the premium. All right, insurance premium to the LIC is 289 rupees, correct? The agents get 30 rupees, and administrative expenses is given to the participating bank of 11 rupees per member per annum. Evaluate the following statements about the benefits under the Pradhan Mantri Suraksha Bima Yojana. 2 lakh rupees is payable for natural death. 2 lakh is payable for death due to accident. 2 lakh is payable for the total and irrecoverable loss of both eyes or both limbs. 1 lakh rupees is payable for loss of sight in one eye or use of one limb. Which statement is correct? Which statement is correct? The correct answer is D. Yes. The Suraksha Bima Yojana, it covers accidental death and disability cover. Right? So in the case of death due to any accident, 2 lakh rupees is paid. Total and irrecoverable loss of both eyes, both hand, feet, 2 lakh rupees. Total and irrecoverable loss of sight of one eye or one hand or foot, 1 lakh rupees. All right. So the correct answer is D, 2, 3, and 4. Okay. What does it mean when dematerialized shares are described as fungible? What is the meaning of dematerialization? When the physical securities are converted into the electronic form and they are kept in the demat accounts. The depository participants, banks are the depository participant, right? So, what is the meaning of those being fungible, the securities being fungible? They are non-transferable and logged in for a period. They carry unique certificate numbers for each investor. They are identical and interchangeable across holdings. They can be converted into the mutual fund unit. What is the meaning? What is the meaning of dematerialization? We have already seen there are two depositories, NSDL and CDSL, the National Securities Depository Limited and the Central Depository Services Limited, right? So they provide the facility of holding and transacting securities in the book entry form. Physical securities converted into the book entry form, electronic form, dematerialization. Reconversion into the physical form, rematerialization. All types of equity, debt, preference shares, everything can be dematerialized. Depository participants are those banks who are registered with SEBI, financial institutions, banks, custodians, stockbrokers, intermediaries, everyone, right? So they can, D? No. Fungible means they are identical. And how can you convert your securities? How can you convert your stocks into mutual fund units? No, they are interchangeable. They are interchangeable across holdings. Okay, they are interchangeable. Okay, let us go through it. So, how do you open a demat account? You will choose a depository participant. You will fill up the account opening form, comply with the KYC requirement, provide a copy of the agreement. Okay, the beneficiary owner identification number is given. It is a unique account number. Unique account number is given. I can open more than one demat account as well, and there's no stipulated minimum balance. It can be opened only in the one person ownership, right? And the demat account will be opened in the same ownership in which the physical securities are there, not in the either or survivor basis. No. If the jointly security is held, then jointly the account will be opened, or maybe the demat securities will be kept, right? Then if you want to make any change, you have to open a completely new account. You cannot change it. Dematerialized securities are fungible. They are interchangeable. They are identical. They can be converted back into the physical form. All right. So these are the features of dematerialization. Which of the following statements is true regarding the ownership pattern in the demat account? Investors can open a single demat account for all shareholding patterns. Demat accounts can be opened in either or survivor basis like the bank account. Joint holders can change names in the existing demat account. Separate demat account must be opened for different ownership patterns. Yes. Which statement is correct about the ownership pattern? One statement I've already told you, demat accounts cannot be opened on the either or survivor basis, right? Joint holders, they cannot change names. They have to open new demat account if they have to make any change. Now between A and D, only one can be correct. And yes, the correct answer is D. The ownership pattern of the security will determine the ownership pattern of the demat account. The demat account in the same ownership pattern in which the physical securities are held. So let's say if I hold two share certificate, one is in my individual name and another I am holding with, let's say, my mother. Okay, so in this case I will have to open two different accounts in the respective ownership. One account will be in my ownership, single, individual, and the second account will be in the joint ownership in which the physical securities were originally held. All right. What is the minimum balance requirement for securities in a demat account? No minimum balance. 10,000 rupees worth of securities, at least one listed share should be there. Minimum 100 units of any security should be there. What is the minimum balance requirement in the demat account? Yes, this also I've told you, even if I'm not holding any security, I have zero securities, then also I can open a demat account. And when I'm going to purchase the security, then I will get it dematerialized and put it in my account. Okay, so the correct answer will be A. There is no minimum balance requirement. As per the RBI guidelines, the aggregate equity investment in a bank by a bank in factoring subsidiaries must not exceed. Banks, they also provide factoring services. They can either do it departmentally or they can do it through a subsidiary. When they are doing it through a subsidiary, they will invest in the factoring subsidiaries. What is the maximum of their paid up capital? 5% of paid up capital and reserves, 10% of paid up capital and reserves, 15% of the tier 1 capital, 20% of the net owned funds. No, not C. C is not correct. It is a part of their paid up capital and reserves. No, not C. The aggregate equity investment in the factoring services, factoring subsidiaries, and factoring companies shall not exceed 10% of the paid up capital and reserves. 10%. All right, remember, it will not exceed 10% of the paid up capital and reserves. Evaluate the following statements about exposure classification in factoring. There are two types, three types: with recourse, without recourse, and limited recourse. International factoring is also there. All right. With with recourse factoring, exposure is booked on the assigner. In without recourse factoring, exposure is booked on the debtor. In international factoring, exposure is booked on the import factor. In limited recourse factoring, exposure is always booked on the assigner. The factoring services can be provided on with recourse or without recourse or limited recourse, right? Without or limited recourse should be with the board approved policy. Credit appraisal of the debtor should be carried out. It will be treated on par with the loans and advances. Also, banks will avoid double financing. All right. When we are talking about with recourse, the exposure will be reckoned on the assigner. Without recourse, the exposure will be reckoned on the debtor, right? And in case of international, refactoring on the import factor. But in case of limited recourse basing, it depends upon the terms of agreement. It shall be reckoned on the assigner or the debtor or the import factor. Terms of agreement between the bank and the customer. So yes, A is correct. In limited recourse, it is not always booked on the assigner. It can be booked on any of them depending upon the agreement. How many questions are left? Just four questions more. Okay. What is the minimum and the maximum investment limit for individuals in the sovereign gold bonds per fiscal year? For individuals, 1 gram minimum, 2 kg maximum, 5 grams minimum, 10 kg maximum, 1 gram minimum, 4 kg maximum, and 10 grams minimum, 5 kg maximum. When we are talking about the sovereign gold bond, let me just tell you everything about it. They are securities denominated in grams of gold, substitutes for holding physical gold. Investors have to pay the issue price in cash, and the bonds will be redeemed in cash on maturity. The quantity is protected. If we talk about the maximum and the minimum, for individuals, 1 gram is minimum and maximum is 4 kg. For HUS also 4 kg. For trusts and entities other than the individuals in HUS, it is 20 kg. So the correct answer will be C. Minimum 1 gram, maximum 4 kg. Yes, correct answer is C. What is the tax treatment of the capital gains on the redemption of the sovereign gold bond? Fully taxable, tax free with no indexation, subject to TDS at 10%, exempt from capital gains tax. How is the taxation done? Taxation. Interest on the bonds will be taxable, right? Interest is taxable. But the capital gains which are arising on the redemption of the sovereign gold bond to an individual has been exempted. Yes, it is exempt from the capital gains tax. Okay. Indexation benefits are also provided to the long term capital gains. All right. So that is the correct answer. Consider the following statements about the Atal Pension Yojana. It is voluntary contribution based pension scheme. Pension is paid monthly after the subscriber turns 60. Spouse receives the same pension after the subscriber's death. Nominee receives monthly pension after the spouse's death. Which statement is correct about the Atal Pension Yojana? So what happens in the Atal Pension Yojana? The name itself tells us it is open to all citizens of India who have a savings bank account, minimum 18 years of age, maximum 40. Voluntary periodic contribution based pension system. The government guarantees a minimum pension amount 1000, 2000, whatever, depending upon the contribution made by each subscriber. After the death of the subscriber, after the subscriber's death, the spouse will be entitled to receive the same pension amount, right? Until the death of the spouse. And when the spouse also dies, then the nominee will get the lump sum amount. Whatever has been accumulated as the pension wealth will be given to the nominee. They will not be getting the same pension as the subscriber and the spouse. Okay. Nominee will only get the pension wealth. Last question. Which organization is authorized to manufacture and distribute the India gold coins? What are India gold coins? Under the government's vision of Make in India gold monetization scheme, 24 carat purity, 999 fineness assuring absolute purity to the customers, the India gold coins are issued. Right? They are minted in India. Okay, they will be mobilized domestically only under the existing gold deposit and the gold monetization scheme. Which authority is minting these gold coins? It is MMTC. Correct. All right, it has been authorized by the central government to manufacture the India gold coins, and it will have on it the Ashok Chakra. This is also important. Okay, it will have on it the Ashok Chakra. All right. So that is all for today. We have completed the questions from Module D. Today in the evening at 7 p.m. 7 p.m. on the Oliveboard platform, we'll be finishing our Module B. All right, the topics that were left from Module B, we'll be covering them. Before you leave, please like the video, everyone. And if you have any questions, any doubts, any queries, you can ask me. Like the video, comment down below, anything. If you want me to add anything, if you want me to do anything, change anything for the final marathon, because now we'll be meeting on the YouTube platform tomorrow. Tomorrow at 6 p.m. We'll be having the part 1 of the Maha Marathon. I do give the explanation. I tell you about the topic. Is it not enough? I try to tell you about the topic, but we have limited time, so only that much I can say. Do you want me to include the theoretical? Theoretical. We will do numericals tomorrow, Krishna. We'll do it tomorrow. Okay, we'll do it tomorrow. Okay, so let us end the session now and we will meet in the evening today and complete our module B. So thank you so much for attending and all the best. Take care and have a great day ahead. Thank you.